We have just a few minutes left in the trading day, so it's time for us to get the big picture with our big picture panel. Joining us today is our guest from Charles Schwab, Collin Martin, the Director of Fixed Income Strategist for Schwab Center for Financial Research. Collin, thanks for being with us today.
Thank you so much for having me.
Of course. So let's kick things off talking about the Fed meeting next week. We keep talking about the Fed meeting, what expectations might look like, especially following Friday's jobs report. What are your thoughts?
Well, we're not expecting any change next week. I mean, if you look at the Fed's dual mandate, both sides of its mandate suggest that the Fed can take a patient approach to policy right now. If you look at the labor market, it's holding in there. There were concerns that it was going to weaken last summer when we saw the unemployment rate rise, but since then we've seen it stabilize for a little bit. In fact, the unemployment rate has hovered between 4% and 4.2%, so a very tight 20 basis point range for the past 12 months. So signs that there would be some significant weakening in the labor market just haven't come. And then when you look at the inflation side of the equation, it's still above target. We've gotten some positive readings over the past few months, but somewhere between the 2.5% to 3% range, depending on the core reading of the day, it's still above target. So the Fed has time to kind of be patient right now and see how everything evolves over the next few months, because obviously tariffs remain top of mind. I think Fed officials are still trying to figure out how that's going to work its way into the actual inflation readings. We haven't really seen it work its way in just yet, but there's an idea that maybe with this week's CPI report, we see it come up a little bit relative to April's number. But tying that all together, we're not expecting any movement at next week's meeting, but we do get the updated summary of economic projections. So we'll get an update from Fed officials about how they see the economic data evolving over the next few months, what that means for the labor market, economic growth, and inflation, and then if there's any change to the dot plot. So I think that's what all eyes are going to be on. Right now, market expectations are for less than 2 cuts by the end of this year. That's been moving a lot over the past handful of weeks, and it might not sound like much, but right now the Fed funds futures market's implying 1.8 cuts by the end of the year, and that's the smallest amount of cuts really since February. So I think it'll be interesting to see how Fed officials see the path going forward, and if that dot moves up to say 1 cut or less.
So to confirm, Collin, you do not expect that we are going to see a rate cut coming out of this meeting next week?
That's right. No movement next week. It'd be highly surprising to everybody if we saw a move up or down.
Do you think we'll have to wait through the entire summer, since you are saying they're only pricing in possibly only 2 cuts in the year? Are we looking into the fall now? Do you think they'll push it that far back, or could we possibly see one before summer ends?
Probably not before the summer ends. We think September is probably the earliest that we'll see it, but it is a moving target. So our outlook through the end of the year is 1 or 2 cuts, but we keep it kind of open-ended because it's going to depend on what the data does between now and then. But September does seem like the earliest cut meeting for now. What we'll need to see, I think, is less on the inflation front and more on the labor market front. As long as the labor market holds steady like it has been, that buys the Fed some time. And even if we go to last Friday's jobs report, it wasn't strong across the board. We have seen a slowdown in non-farm payroll gains, but I think that's natural when you are late in the cycle like we are now. We have seen, though, negative revisions to the last 2 months. So maybe it's not as strong as expected, but the consumer appears to be doing okay. If we look at the breakdown of where the job gains are, leisure and hospitality is something we always look at. That's really where we as consumers are spending those discretionary dollars. And we're still seeing job gains in leisure and hospitality. And we saw average hourly earnings increase a little bit more than expected. So consumers are continuing to consume. So as long as that's happening and inflation is kind of where it is right now, that could just push back the timing of that first rate cut.
So we're talking a lot of data here. Consumers still spending. Obviously, we have some big inflation data coming out on Wednesday with CPI. What are your expectations for that report?
Well, we don't give official forecasts, but the markets and the street expectations are for, if you look at core CPI, a 0.3% increase, that'd be slightly higher than what we got in April. And on a year-over-year basis, expectations are for a 2.9% increase, which also would be a modest increase relative to April. If we look under the hood at the inflation readings, we're really seeing a dichotomy where we're expecting to see some goods price increases because of the tariffs. I mean, it's going to take some time for that to work its way through and as it flows through to the consumer, but we're expecting goods inflation to pick up. Meanwhile, we've seen some services disinflation. Even though the consumer continues to spend, we're not sure if it's really accelerating its pace of purchases. So I think the question is going to be which outweighs the other. Will it be a disinflationary trend in services or a potential tariff-driven increase in goods? But as it stands right now, it looks like we're going to get more of the same. So, 2 to 0.3% increase from a core standpoint, and on a year-over-year basis, close to 3%, but hopefully just below.
So do you think in those two options, whether or not we have a disinflationary trend in services or if we see that tariff uptick, is one of them better than the other?
Well, I'd say the tariff induced goods increase is better than the other because that wouldn't necessarily have to do with consumer behaviors. If we look at the services side of the equation and the disinflationary trend there, if that's the result of weakening job prospects or maybe dwindling savings, incomes not growing as much as expected, that in and of itself would likely pull growth down the road. So I think if we're looking at what's going to be the driver of a potential growth slowdown, it would likely be a slowing in services inflation because that means consumers, the real engine of our economy, are beginning to slow.
Collin, thank you so much for your time this afternoon. We truly appreciate it. Again, that's Collin Martin, the Director of Fixed Income Strategist for Schwab Center for Financial Research.